What's going on, everyone? My name is Nicholas Merton here from DataDash, and today is September 4th of 2023. Well, folks, I hope you all are having a fantastic day wherever you are, because in today's video, we've got to spend some time to talk about a make or break level for Bitcoin here in the near term, as Bitcoin has pulled back from around $32,000 to $26K since back in mid-July after a month and a half of consolidation, as we now have lower prices for Bitcoin. This is the range where bulls need to show up. I want to spend some time to talk about why that is, but outside of that as well, dive into the macro perspective where I feel a lot of people may be missing some key valuable hints that can let us know what may happen in the next weeks to come for crypto prices. We got a lot to uncover in today's video, so if you guys happen to enjoy it, consider dropping a like. It's one of the greatest ways you can support the channel, and let's go ahead and kick off the rambling. All right, I want to go ahead and start off strong here, guys. Let's focus in on Bitcoin's price. We need to analyze something, which is taking a look at how price reacted in the past and comparing it to where we are here today. This is one of the biggest areas of technical analysis that I feel people miss out on. So many people focus on trend lines, they focus on certain technical patterns like ascending triangles or descending wedges or bull flag patterns. All these things are valuable. They do signal, the confidence of price. However, I also like to do something that I think isn't taught very well in TA, and that is essentially looking at support and resistance, and on top of that, looking at how price reacted at critical levels for support and resistance in the past versus how they're reacting now. And taking a look over a set of days or weeks, because as we get more price action at these levels, we can start to see whether or not people are showing up to the plate or not. Are the bulls or the bears in the lead? Has sentiment changed during that period of time? Because generally speaking, that's what market price is. At any given period of time, it's demonstrating when people are eager to buy and when people are eager to sell. Now, what I find really fascinating here is that after a long period of time, basically correcting here, about a month and a half coming down here from mid-July here to where we are at the beginning of September, what I find really fascinating is how long we've been actually sitting here. It's crazy, but it's been a couple weeks here where Bitcoin has essentially been pushing sideways at this level of $26,000. And of course, sometimes we dip around 25K. We had the bump up off of the overhyped news around the grayscale victory against the SEC, up towards around 28K with the rejection at the 200-week moving average. But generally speaking, we sold off those gains and we're now just sitting flat here. Whereas back here in June, we had trend direction, right? When we came into this pocket of the 200-week moving average, hence why we're talking about this price range, it's a very significant price point for Bitcoin to essentially prove to itself in the market as a whole that it could be in a new bull market, right? Last time we came to this range, we only sat in the 200-week for about a week, roughly speaking, right? 7-9 trading days, give or take. Depends on what specifics you want to focus on, if it closed or not in that range. Generally speaking, we spent about a week there. This time around, we had something very different. Unlike last time where we blasted out of the 200-week with two strong green candles making up over a near 12% move in that period of time, up towards new relative highs and testing the same resistance range in April, this time around, we faced the 200-week, we got shot down, and we're still chopping in this range. That's a very big difference from what happened last time. And if you're just analyzing, technical patterns, and you may even be going as far as to do support and resistance analysis, you may be capturing a lot of it. But if you aren't listening to how price is telling you this story, it's telling you essentially that, hey, whoa, we didn't have enough steam to blow through the 200-week this time. And on top of that, we have spent much more time here, well over double the amount of time here within this pattern between the 200-week, which is now acting as resistance, and the 200-week EMA. So we have the simple moving average or standard moving average, and we have the exponential moving average. Now price is bouncing in between these. And that's not a good sign to see, because it's showing that even after if you're taking it from the absolute relative highs here, because everyone loves to do that on the bottom, they say, oh, you could have bought at this price range and done this. Fine, we'll do it here on the downside, right? From 32K, roughly speaking, the high was 31,800. Let's round it off, 32K, down here towards around 26K. We've got a really solid discount here for Bitcoin, about 6K discount from those relative highs. Now, theoretics would tell us that if we're in a bull market, we buy the dips. We set in those higher lows versus the past. So we've got to have the bulls come up here and show that the 200-week range here is not going to be resistance. It's going to be support. similar to how it was here in June. Right? Essentially speaking, again, go with off the bullish narrative here. You can see how the 200-week was still acting as resistance multiple times here in Q1 from early January to around mid-March. And then we were able to clear through there. And that was, again, the conviction that we must be in a new bull market. Well, bulls have got to show up here and buy the dip. They've got to do it here, because if they don't, it's going to become more and more clear here that essentially the resistance range we've talked about. Go ahead and pull up the Bitcoin chart that we like to use, the all-time history index, right? We've got our different support and resistance ranges here, right? That this 28 to 32K pocket, which was prior support in the last bull market in 2020 and 2021 and 2022, that range is now resistance. And that the ascending channel we were building up here has failed, that we could not clear through that range, and we are no longer holding on the 200-week. Every single point that originally gave bullish conviction and started to showcase that the bulls were in charge are falling like dominoes, one by one by one. That's not me telling you that, guys. It's market price action. That's, again, I really want to iterate here, guys. I'm not here to be negative at the end of the day. I would love, man, trust me, for my channel, for the business as a whole, I would love crypto to go up to new all-time highs, right? And that may be what I think we all would want to see, but it's likely not going to be the case because the macro environment is at play. And it is starting to demonstrate its effects on Bitcoin here. The divergence in supply and demand, the available Bitcoin that's willing to be sold on the market at these prices versus bought, it is abundantly clear here. And now we are below the 200-day, we are below the simple moving average for the 200-week. And if we break through this line here, the 200-week EMA, where are we going? We're entering into no man's land. There isn't really any clear ranges of support and resistance. I mean, you could draw some here at like even levels like 22K, where there was resistance back here, maybe some support around that range. But it just gets really confusing. And at that point, what are you really trading? Are you trading for the new bull market? Or are you just trading for maybe another relief rally like we realize that this is now, right? Which we've been talking about for a year now, that this is nothing more than a relief rally. Well, this is the point I want to get back to, guys. Is there enough room for a bull market? And if there isn't, then we've got to be cautious and we've got to expect that things are likely going to move lower here. Ethereum looking just as bad as Bitcoin here. Barely holding by a thread on the 200-week after it broke the 200-day. Used to get support on the 200-day, those blue lines as we just zoom in here. Again, what was previous resistance turned into new support. Well, we snapped through there again. We faced resistance here, as you can see on the weekly candle back in late August. And we are holding by a thread on that 200-week along a more than year-long ascending triangle, which again, I will reiterate, is a bullish pattern. But it is only bullish if by the time we get towards the end of the pattern that we've essentially held the higher lows and we've been able to snap through and break to the upside each and every time we failed. Over 3 times here, we failed at that range. And now it looks like we're ready to snap lower, right? And that's again why, as we talk about it here, our price targets probably don't sound so crazy now, right? I know a lot of people were like, Nick, you think $300, $500 Ethereum? Like, really? Maybe it's not going to go absolutely all the way down there, but we are keeping open to that, guys. Because if it doesn't hold down here at $879, the prior low in June, right? It's in no man's land. There are no significant ranges here of price support. So again, I'm trying to keep open here to these ideas, but really the fundamentals are weak right now in the broader DeFi ecosystem. The reasons you need to buy ETH right now, I think, are relatively weak. That's not me hating on Ethereum. I spent a lot of time in the ecosystem, but I don't mean to be hostile towards any potential people out there who are investing in these assets. I think that eventually maybe we'll get these at a good discount valuation where they do make sense, but the momentum is not there, and price is telling you that. Now, I want to go ahead and explain why this is, guys. It's not just crypto here that's showing signs of weakness. If we look across the board in equity markets, we will see, if we look beyond, Nvidia and Apple and some of these big technology stocks, we can start to see that the picture has been clear for a while, that we're in a contractionary environment. We have been so since back in Q4 of 2021 and Q1 of 2022. Right? That 6-month window was the clear trend change where we started to see, for example, XLF, or the broad ETF for the financial sector, starting to move lower. And for multiple months, we faced resistance at a consistent range, setting a new relative high aligned with the 2 prior highs. And we can see here in July, facing resistance at that line again. And we got to see whether or not the bulls can drive it up here, right? We got a nice little bump up here for this week, But again, it's looking like we're just going to hit here again at the same range or have a failed breakout and just continue rolling over and over and over down to lower highs and lower lows. This is an important point I want you guys to understand here, because when we're in a contractionary environment, when we're at the end of these longer term 10-year long bull runs like we had from 2010 to the early 2020s, you have long bear markets, and they can be incredibly deceiving, they can be incredibly disorienting, and more than anything, pry on your emotions when there are relief rallies without the substance to really kick off a new bull market. And this is again a sign here, the XLF is a prime example here of essentially how that contractionary environment is starting to affect the financial sector. More importantly, we take a look at IIT. These are the regional banks, right? The ones that were the SVBs, the First Republic, all these banks that were starting to collapse back in March because of tightening interest rates. Well, there's a lot of banks out there that are hoping at this point. They may be in a stronger position than those banks, and that's why they're still around, but a lot of them are still locked into fixed income assets. And essentially, if the Fed target rate continues to move higher and interest rates generally just go up higher and remain higher for a longer period of time, this is going to squeeze a lot of these names, right? And when we're talking about IIT here as an ETF, I'm looking to see whether or not we're going to start facing resistance yet again at the same range we're at in March, because if we can't escape this range here and start filling some of these higher gaps and start seeing buyers come in and take advantage of the dip, then this likely is moving lower. And I want to bring it here to the longer term time frame. We've talked about IIT, even though a lot of people are chasing the dip here, that this could go lower, that we may need regional banks to come down here and set in a third generational low here in accordance with the line of descending support since back in July of 2013. Similar situation to many banks in Europe. I think that inevitably we are going to get to this point here where either regional banks get squeezed by the bigger banks, taking more market share during a higher interest rate environment, or essentially the thesis for investing in these banks just simply weakens over time and essentially brings us down here towards around $21 to $20 a share. Right? There is a very good chance here, especially when you see these kind of the first big move here in July getting kind of squeezed out here with a 9% decline in August, a lot of those gains being taken advantage of, and we're not able to escape back to the upside. What was previous resistance that would get broken multiple times in the past is now starting to act much more heavy on price. And that is not a good sign here. This is showcasing that equity markets are starting to price in those who are watching it much more carefully, right? Essentially speaking, they are pricing in that there's a chance that the Fed is going to keep rates higher. And it's not just equities. Bonds are showing us this. The US 3-month yield. I know a lot of people are like, Nick, why are we looking at bonds? I don't want to buy bonds. Bonds seem boring. You don't have to trade bonds. But if you analyze what they're telling you, it'll tell you a lot about where the Fed could be taking things. The 3-month yield, right? Still not budging at 5.4%. The US 2-year yield, still holding up towards its relative highs here, the highest levels we've seen since July of 2007. And looking like it very well could be, as it has higher lows here, facing that same resistance range, it could potentially pop out here with another Fed rate hike. And the US 30-year yield. This is where the real message comes, guys. We can see over the past couple months, we've come up back towards the relative highs from October 2022, while equity markets are living in la-la land. Essentially speaking, bond yields are moving up, and they're showcasing here that, look, you may believe in your narratives of AI and, that the FANG stocks are just going to recover and whatever it may be, and that BlackRock, Bitcoin ETF, and the halving, yada, yada, yada. Doesn't matter what the narrative is, yields are going higher. The Fed is still tightening. We've been on this message for a long period of time because essentially it is a sign of the times to come. That essentially we are no longer in the more than 40-year long period of time where interest rates were declining. We are now out of the bond bull market. Essentially, we are entering a period of time where rates are going to move higher here. That there are going to be more defaults. There are going to be more corrections. Equities and other assets are going to have to reprice. And we are likely going to see, in order for the Fed to balance against inflation and bring supply and demand back into equilibrium, as Jerome Powell has said many times, they are going to have to raise rates higher. And that is going to put bond yields higher. And it's going to make bonds, which will be at a discount, paying a higher yield, a much more attractive investment vehicle for capital sitting on the sidelines to go into versus going into equities. That's the brutal reality we need to face, guys. I think there's still a lot of people out there who are not ready for a world where the US 30-year yield goes from paying 4.3% to 4.8%, or going up towards 6%. I know it sounds crazy, but I gotta tell you guys, if we take it back a couple years ago, saying that bond yields would have surged from 1.2% up to 4% in a matter of less than 2 years, you would have been seen as crazy by many people. And back a year ago, when everyone thought the Fed was topping their target rate at 2.53%, we were saying 5%. Everyone thought we were crazy. The problem was we weren't conservative enough. The rates actually went higher to 5.5%. So you got to listen to those voices who are helping to protect your capital right now, guys, and are focusing on that long-term vision. Now, the last thing I want to talk about here, going into the short term, I have no doubt that over the next 2 or 3 days, equities could continue moving higher here. We've already recovered the majority of the retracement here. I think this is mainly led by the technology stocks. Apple is going to have a big event here over the next couple of days where they reveal likely the new iPhone, the iPhone 15. And outside of that, I have a feeling they're going to push on the AI narrative as well. But if they do that and they push all that into one event, I got to tell you guys, I think Apple will possibly have a profitable move on the day. It'll move up, maybe set a new all-time highs or relative highs. And then after that, I think it's going to be the time to deviate short and start betting on the downside. That's going to be where it's exhausted at this point, because Apple is what's been holding up the market here, guys. And if Apple doesn't really have the momentum to continue forward, and we start moving back down to this line of prior resistance, which I think is going to be attempted to be new support, which may not hold, that's a significant move to the downside, which is going to weigh down other global equities. If the prior market leaders are not holding up, then that's going to weigh down equities. So again, that's going to be on the 12th, so that's going to be sometime next week. So keep an eye on that on your calendars. But I think, again, until then, I think equities have the green light to just continue holding up here in the near term. I'm not trading them to the long side. I'm just saying that, Bitcoin might have another couple days where it ticks up a little bit green. The key point comes back here towards the topic of the 200 week. I don't think you're going to see a clear through here. Then again, that's also why we shouldn't short until we get confirmation that this is going to break down, right? Also, I know some people have asked about the cannabis sector. Cannabis sector got a pretty significant bid here in the late part of August, early part of September. Generally speaking, guys, with all these moves, right, where you retrace, multiple months worth of losses, actually an entire year's worth in just a few trading days, this gets a lot of people juiced up. And it's definitely something I'm interested in watching. However, it's important to note that cannabis makes these kind of moves time and time again. We had actually one trading day here back in October 2022 where the entire cannabis sector, roughly speaking, moved up 33% across the board, right, in a single trading day. And what happened? Well, the month to follow, they continued back up to those relative highs, deviated, and basically just moved down constantly. People took advantage of it. They sold off. And we didn't get the start of a new cannabis run-up. So with these moves, it's best not to FOMO into them until you got real conviction. It's not about chasing absolute bottoms. You don't want to try to catch a falling knife. You want to know when the momentum's there, when it's time to get your ticket on the rocket ship and ride with the trend. That's what smart traders do. And again, I'm definitely interested here in this move, but I'm waiting for the retracement to see if we can turn some of these prior ranges of support in the past into support once again. Maybe this is the level that really stands out for me, right here at about 615 or 625. This range here is definitely a range of interest here for potential support to formulate. And if that does, if it holds up here consecutively and we move past the prior highs, that's when I get interested in cannabis stocks. And that's when I get interested in more risk on assets. Now, if you guys are watching sectors like cannabis, if you're stepping out, if you're watching the broader macro indices, you're already on the right path here. We here on the DataDash channel are not just focused on crypto, we're focused on the macro. After trading for 12 years, I've learned that if you do not have a holistic picture on all markets, viewing how things are working, how they interact with one another, you're gonna miss out on market opportunities. And if you are right now 100% exposed to crypto, I'll tell you guys this, if you made it this far here, right, and you see that I'm just giving my candid opinion here, I'm saying it as a friend, that's one of the biggest mistakes you can make. And I say that as someone who covered crypto since 2016, we've been around for 2 big bull markets, I've known about Bitcoin since 2011, I resonate with the message of crypto, but on an investment perspective, guys, that can be a huge problem. And we here are focused on a whole range of new sectors that are going to be potential market leaders. And I gotta tell you guys, they're not likely gonna be cryptocurrencies. It's gonna be other sectors within equities that we think are gonna do very well, and some commodities as well. So if you guys are interested in learning about those sectors, I highly recommend you guys check out the Dash report. I'll leave a link down below in the description, but this is our newsletter here on the DataDash channel, where we essentially cover cryptocurrencies, equities, commodities, and Forex. We've got hundreds of members out there in the Dash report community, so you can become a part of a community of some of the best minds in our ecosystem within the DataDash channel. We've got the mid-month webinar, the newsletter, which is over 20 pages. You guys get access to the red, blue momentum indicator that we discuss here in the channel sometimes. And outside of that as well, you'll be able to access the Dash report discussion group. If I mentioned already, the trade alerts where you guys get access towards our trades and all kinds of other things. It's a really big offering here, and you guys can get 20% off if you sign on an annualized basis. It's a great way to support the channel, and it's a great way as well to get that additional 25% of content beyond the videos here that can really let you know when we're actually making moves in the market. But that's it for today's video, guys. I hope you guys enjoyed it. If you guys are interested in the dashboard, you can check it out at the link down below in the description and take advantage of the 20% yearly membership. But outside of that as well, keep an eye here on the 200-week moving average. That's the key range we're watching it for Bitcoin. It is a make or break level here, guys, because if we do not get buyers here, if we don't start to see some optimism, how can we say that we are in a bull market at this point? That's the key message here, guys. So thank you all for letting me ramble on here today. I hope it provided some value for you all, and I'll see you guys on the next video on Wednesday at 6 a.m. Eastern Standard Time. Take care, everyone, and I'll see you all in the next video.